Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and in today's lesson, we're going to be going over the types of itemized deductions that you can take on your tax return. Now, if you haven't seen my previous video on the standard deduction, make sure you go ahead and watch that too, because these two are going to be compared a lot during this lesson, because as you hopefully know, taxpayers can either take a large standard deduction or larger, or specific itemized deductions for specific expenses. And as a tax preparer, you want to know how to calculate both so that you can compare the two and see which one results in the least amount of tax. All right, as always, the guided notes are linked in the description down below. So follow along, stay engaged, and practice with some of the material to see what you learned. All right, let's get started. So what are itemized deductions? Well, itemized deductions are subtractions from a taxpayer's adjusted gross income. And make sure that you also see my video on adjustments to income, because adjustments are always going to come first before deductions. Hence why we're deducting from the adjusted gross income. And these specific subtractions correspond to specific expenses that the taxpayer may have incurred during the tax year. And these reduce the amount of income that is taxed. Taxpayers have a choice of taking a standard deduction or taking the itemized deductions, as we've mentioned, and taxpayers should choose either the standard or the itemized, depending on which deduction results in the lowest tax. All right, so itemizing deductions. Who must itemize? Meaning they cannot file for the standard deduction. Taxpayers who must itemize are those who have a standard deduction of 0. And these are those who filed for married filing separately status, and their spouse is itemizing, regardless of who files first. So if you're a tax preparer and you're helping a client who's claiming married filing separately status, and their spouse is filing under an itemized deduction, they're doing itemized deductions in their tax return, the taxpayer you're helping, even if they want to claim the standard deduction, they cannot. Both spouses must itemize if one or the other chooses to. Head of household status can also use the standard deduction even if their married filing separately spouse itemizes. That's just something to know. Okay. And filing a return for a short tax year or filing a return for a non-resident alien or dual status alien during the tax year is out of scope for the Volunteer Income Tax Assistance Program, but those are also the types of people who would have a standard deduction of 0 and would have to itemize. And always, who must itemize, you should itemize if your standard deduction is less than what it would be for your itemized deductions. Now, when should you recommend a taxpayer to itemize your deductions? These are kind of clues. If you see them on the tax return, these are kind of clues that, hey, this taxpayer should probably itemize. And these include deductible mortgage interest, state taxes, charitable contributions, large amounts of unreimbursed medical and dental expenses, or casualty and theft losses. Okay, so in this lesson, we're going to be going over the main types of expenses that will be deductible, that will result in the deductions that count as your itemized deductions. So the first type of expenses that we're going to be going over are medical and dental expenses. And how do you know if they're going to be deductible? Well, only the amount of unreimbursed medical and dental expenses that exceeds 7.5 of the adjusted gross income is deductible. So you have your adjusted gross income, say that's $2,000. It's a really low number, I know. But your medical expenses are over 7.5% of that. Hold on. Say we're just going to use really small numbers just for simplicity's sake. But say your AGI is $100 and your medical expenses are $8. Since that exceeds 7.5 is 7.5% of the $100 is $7.5. Now the amount that the $8 exceeds is only 0.5% or 0.5 or 50 cents. That 50 cents is the only amount that will be able to be deductible for medical and dental expenses. Qualified medical and dental expenses paid by are those expenses that are paid by the taxpayer during the tax year and can be included for only the taxpayer spouse, or dependents claimed at the time of services. Also qualifying medical and dental expenses could be those for possible dependents. And what I mean by possible dependents, is that in our dependents lesson, we covered the different tests that you have to meet in order to be a dependent. And you had to meet all those tests to be either a qualifying child dependent or a qualifying relative dependent. Well, if the possible dependent passes all the other tests except the joint return, the gross income, or the claiming as a dependent tests, if they fail those ones only, then you can still include the medical and dental expenses paid for them. It's just like a little exception. Now, what happens with divorced kids or divorced parents paying child expenses? Well, I have this example here is that Stuart and Carmen are divorced. Their son Raymond lives with Carmen, who claims him as a dependent. Carmen paid for and deducted Raymond's standard medical and dental bills. Stuart deducted the emergency bill he paid when Raymond broke his arm. If the child of a divorced or separated parents is claimed as a dependent on either return, each parent can deduct medical expenses they paid for the child. So if Stuart is the custodial parent, Carmen is the custodial parent in this situation. She claims him as a dependent. She's taking the claim for him as a dependent. However, Stuart could be possibly, if they transferred if they transferred Raymond over to Stuart could possibly claim Raymond as a dependent. Because Raymond could possibly claim him as a dependent, he can deduct any medical expenses paid for the child. Okay. A few little things to note when dealing with deductible medical and dental expenses is premiums. So only premiums for long-term care insurance are deductible up to a limit based on the age of the insured. And this changes every year, so make sure you're up to date with it. The TaxSlayer software will usually calculate for you, but it's just a good thing to know. This shouldn't be confused with premiums for life insurance, which is when you die. That's not the same thing, so don't get those confused. Retired public safety officers can't deduct medical expenses as premiums if they paid with tax-free distributions from a retirement plan. So if you watched our retirement income lesson, then you would kind of know that retired public safety officers, they can take a tax-free distribution from their retirement plan if they use it to pay medical expenses or premiums. But if they use that tax-free distribution, then those expenses can't be deducted from their AGI. And finally, only unreimbursed costs qualify for the deduction. Sometimes your employer or your insurance company will reimburse costs, meaning that you went to the hospital and the insurance company was like, oh, we'll cover it, we got you. Or your employer, this injury happened on the job and you had to go see a chiropractor, your employer might reimburse those costs. They might give you money back. If they reimburse that cost, you can't deduct those costs from your AGI because you didn't pay them, if that kind of makes sense. Okay, now that we covered medical and dental expenses that are deductible, now we're going to go into what taxes are deductible. And taxpayers can deduct certain taxes if they itemize. But to be deductible, a tax is legally liable and paid during the tax year, meaning that the tax is levied on the taxpayer and it's paid during the tax year. And types of taxes that would be deductible include state and local income tax, withheld taxes, estimated tax payments, other tax payments, etc., sales tax in lieu of state or local income tax. So I live in Nevada. We don't have a state income tax. However, if the state income tax is zero, but you still wanted to deduct something, we can deduct sales tax. But it's not sales tax, meaning I pay sales tax on my iPhone 16. You would only pay sales tax on motor vehicles, boats, aircrafts, or home constructions improvements that you bought. Sales tax from those types of purchases can be deducted if you don't deduct state or local income tax. And real estate taxes are also deductible, so property tax and mortgage interest. Okay, how are you supposed to handle these deductible taxes when preparing the income tax return? Well, the deductible taxes are reported on Form 1040 Schedule A. And, sorry, and the total deduction for state and local income tax or sales tax that a taxpayer can actually get is limited to $10,000 for every filing status except for married filing separately. And married filing separately, they're only limited to $5,000. Now, state and local income tax doesn't include penalties or interests, and you should enter the sales tax as well, even if they're taking the deduction for state and local income tax rather than sales tax, because the software will calculate the better amount and thus have to pay at a lower rate. Foreign income tax can be taken as an itemized deduction as a credit against U.S. tax, but you should use the greater amount. And only qualified foreign income taxes that are $300 or less are in scope for the Volunteer Income Tax Assistance Program. So if you are trying to get your taxes done by a VITA site, then only foreign income that is $300 or less would qualify. Okay. Now moving on to interest. So what types of interest are deductible? And there is two types of interest that can be deductible, and that is home mortgage interest, which is any interest paid on the loan, line of credit, or home equity loan on a taxpayer's main or secondary home. Now, this differs a little bit. In previous lessons, we talked about how your home has to be your main residence, but home mortgage interest on that can be deducted can be on a taxpayer's main or secondary home. And this deduction can only be used if the loan was used to buy, build, or substantially improve the qualified residence. Now, what does this all mean? Basically, if you take out a loan for a mortgage, so say you take out a $2,000 loan to, I know that's really low, but you're taking out a $2,000 loan to pay for your mortgage. And then on that loan, you have to pay interest. That interest that you pay every year, so say you pay like $100 in interest every year, that interest is what is deductible from your AGI. Now, a taxpayer who refinances and increases the loan, and they usually do this to pull out some money to finance another expense, like say a car loan expense, only the interest on the qualified home that's going towards a qualified home mortgage amount is able to be deductible. So if they are putting it to a car loan, then the amount that was still used in the loan to pay for the home, that is what is deductible, not the one that is going to the car loan. And interest on a reverse mortgage is not deductible until the loan is paid in full. And if you don't know what a reverse mortgage is, it's kind of like selling your equity in a home and timing it so that you're, instead of having to pay the interest and the loan payment, you're just slowly selling part of your equity. And it's usually done with older people who want to time it so that they have nothing, if they don't have the home to leave to their inherited peoples, they usually time it so that they use up all their equity and it's sold to the bank when they die. Kind of sad, but that's kind of how a reverse mortgage works. And it is not deductible until the loan is paid in full. What that basically means is you can't really deduct it because you're not paying the loans. And the loan is only paid in full when the taxpayer either moves out or dies. And that's just kind of how it works. All right, the other type of interest that is deductible is points interest. And this was a new vocab term for me. So maybe you're wondering, what are points? Well, points are charges paid by a borrower and or seller to a lender to secure a loan. And only points paid as a form of interest can be deducted. Points must be spread over the life of the mortgage, so you can't use all your points at once. You have to kind of spread it out as you have the mortgage. And if it's used for the main home, they can deduct the entire amount of points for the amount in the year paid. All right, we're almost to the end, guys. We only have two more types of expenses that can be deducted. And one of those is gifts to charity. A donation and a charitable contribution, this is what we call a gift to charity in like legalese. And it's a donation or gift to a qualified charitable organization. Now, one thing to note for a qualified charitable organization, It can't be to any of your blood relatives. It can't be to any second party organizations. It has to be a listed qualified charitable organization. And those include things like your church or any nonprofits that are listed. You can, taxpayers, there is a publication, I think it's publication 57, that tells us what types of organizations that are charitable organizations. So you should look that up if you have a question about if your charitable contribution counts as a charitable contribution to a qualified organization. Now, taxpayers whose charitable contributions total more than 20% of their AGI may deduct only that percentage from their contributions and must carry over the remainder to the next tax year. So, you can deduct any charitable contributions up to 20% of your AGI. If it goes over 20%, then that over 20% portion has to be transferred to the next year, and you can deduct it next year. Now, in order to deduct, the taxpayer must have records, accurate records, and these include credit card statements, bank records, or receipts that kind of note that, yes, you actually paid this to a charitable organization. Okay. And the last one we have is miscellaneous deductions. And these include either gambling losses and expenses or work-related expenses for disabled individuals that enables them to work. So these are two very specific types of miscellaneous deductions. And if the taxpayer has either one of these, only the portion of miscellaneous itemized deductions that exceeds 2% of the AGI is able to be deducted. All right, guys. Thank you so much for listening on itemized deductions. Once again, if you want to learn more about the standard deduction that a taxpayer could take to compare the two to offer the best plan for the taxpayer, please see my lesson on standard deductions. All right, guys. Thanks for watching. Have a great day.